We are 1 week out from the Federal Reserve's Jackson Hole, Wyoming Symposium. This time, 1 year ago, the Fed Chair Powell said pretty staunchly that it's going to be painful. And we're going to jump into the charts. It is painful once again. Interest rates hitting another high, coming very close to the highs we found last fall after the Fed chairman spoke. So in his speech last year, he made it really clear that they were not done raising rates, which they have continued to do, just most recently here with their 0.25% rate hike. And it doesn't look like they're quite done yet, or at least they don't want to let us know if they're willing to take their foot off the gas. Let's check out the charts. Today we're starting the week off Monday with 20 basis points down on the mortgage-backed security prices. The red is bad here. The 10-year treasuries, we're going to focus the last year. That's this chart below. So the Fed chair spoke last August, and he said it was going to be painful and basically gave his warning to the markets that we were going to see continually higher rates as far as the federal funds rate goes. And we saw the stair step. I mean, holy cow, from the end of August right up until they peaked on October the 20th. In 2 months' time, we saw effectively 1% higher interest rates in that swing. So we've seen over the last year it's come down, it's come up, it's come down, but we are testing these highs. So if we run this line across, we have not seen these levels in interest rates since last year or the end of the year. So here's just the last 3 months, and we can see that we did hit this high on August the 3rd, and it did appear that we were going to get a break and bring interest rates down a little bit. Just this last week, just stair-stepping once again. This in the face of a pretty mild CPI, or the Consumer Price Index report, and the Producer Price Index came out last week, and we still saw with relatively low year-over-year inflation, 3.2% on Consumer Price Index. That is not cutting out food and energy costs, but when we do, the Fed's core rate actually dropped, which was huge news. But in the face of that, unemployment starting to come up. We've got more unemployment claims or new claims for unemployment benefits. And in the face of that, Thursday and Friday climbing to these year-to-date highs. So we do talk about the 10-year, the 20 basis points lower on the mortgage-backed security. Now this is the cost to the investor. Investors purchase these mortgage-backed securities, and they're not buying. So as the price is falling, they're having a hard time giving them away. Investors are still trying to figure out what direction is the economy taking, what is the Fed going to do, and is the economy teetering on the edge. So we will get more updates this week. On Wednesday, we get the Fed's minutes from their last meeting, where we get a little insight into the conversations that were had. We do know that they raised rates, but were they discussing a pause into the next meeting that we will not see until late September after this upcoming symposium next week? We will see lots of speeches. There could be market moving information coming up. But definitely between now and the time the Fed actually meets again. So we will get PCE at the end of the month. That will be right at the end of August. And then before the Fed meets again in September, we'll get another round of Consumer Price Index and Producer Price Index to give them a full scope of the unemployment rate and the inflation picture before they have their next meeting. So we'll keep an eye on that and come back at you next week.